Hello, friends. Today's topic is taken from the book Technical Analysis of the Financial Markets by John Murphy, where we explore some of the most powerful tools and strategies used by traders worldwide. We'll start by learning how to identify trends like a pro so you can spot market movements before they happen. Then, we'll break down the top 5 most powerful chart patterns that signal high probability trades. Next, we simplify moving averages, making them easy to understand and apply. We'll also dive into RSI, MACD, and Stochastic, 3 of the best oscillators to refine your trading decisions. But that's not all. We'll explore Japanese Candlestick Patterns, revealing how they predict market reversals. Then, we uncover the secrets of Elliott wave theory, a fascinating approach to market cycles. And finally, we'll decode Dow theory, the foundation of modern technical analysis that still shapes trading strategies today. So, if you're ready to sharpen your trading skills, make sure to like, share, and subscribe for more insightful content. Now, let's get started. Identifying trends like a pro. The market moves in trends, and if you can spot them early, you gain a huge advantage. This is all about recognizing trends, whether the market is going up, down, or moving sideways. It also covers how to use trend lines, support, and resistance to make better trading decisions. Understanding uptrends, downtrends, and sideways trends. Markets don't move in a straight line. They follow patterns, and these patterns fall into 3 main categories. 1. Uptrend. Prices move higher over time, forming a series of higher highs and higher lows. This signals that buyers are in control. 2. Downtrend. Prices decline, forming lower highs and lower lows. Sellers dominate in this phase. 3. Sideways trend. Prices move within a range, bouncing between support and resistance levels without clear direction. Spotting the trend matters because trading against the trend is like swimming against the current. It's exhausting and often unprofitable. Using trend lines for better trades. A trend line is one of the simplest and most effective tools for identifying trends. In an uptrend, draw a trend line connecting the rising lows. As long as the price stays above this line, the trend remains intact. In a downtrend, draw a trend line along the falling highs. If the price stays below this line, the downtrend is still strong. In a sideways trend, trend lines can help identify the boundaries of support and resistance where the price keeps bouncing. Trend lines act as a visual guide, helping you see whether a trend is holding or breaking down. Support and resistance, the market's invisible barriers. Support and resistance are price levels where trends often pause or reverse. Support, a price level where buyers step in, preventing the market from falling further. If support holds, the price bounces back up. Resistance, a level where selling pressure increases, preventing the price from going higher. If resistance holds, the price drops. When a price breaks above resistance, it often signals the start of an uptrend. When it falls below support, it can indicate a downtrend. These levels aren't just lines on a chart, they represent real buying and selling activity. To trade successfully, you need to read the market story. If you spot an uptrend, focus on buying opportunities. In a downtrend, look for short selling setups. If the market is moving sideways, be cautious. Trading inside a range can be tricky. By mastering trend lines, support, and resistance, you gain the ability to anticipate price movements instead of reacting to them. That's what separates a skilled trader from the rest. 5 most powerful chart patterns for traders. When it comes to technical analysis, some chart patterns have stood the test of time and continue to be powerful tools for traders. These patterns help in predicting price movements based on historical behavior. Understanding them can give traders a significant edge in making well-informed decisions. Let's break down the 5 most powerful chart patterns, how to spot them, and trade them effectively. 1. Head and shoulders. This is one of the most reliable reversal patterns, signaling a shift in trend direction. It consists of 3 peaks, a higher middle peak, the head, and 2 lower peaks on either side, the shoulders. The line connecting the lowest points between these peaks is called the neckline. Spotting it. The pattern typically forms after an uptrend, indicating a possible downtrend reversal. Trading it. Once the price breaks below the neckline, it confirms the pattern. Traders often enter short positions at the breakout, setting stop losses above the right shoulder. Inverse head and shoulders follows the same principle but signals a bullish reversal after a downtrend. Here, traders look for a breakout above the neckline to go long. 2. Double tops and double bottoms. These patterns indicate trend reversals and are relatively easy to spot. Double top? This occurs after an uptrend when the price tests a resistance level twice but fails to break through, forming two peaks. The price then reverses downward. Double bottom, the opposite of a double top. It forms after a downtrend when the price hits a support level twice and rebounds, signaling an upward move. How to trade it? In a double top, traders look for a break below the support level between the peaks to confirm a downtrend. In a double bottom, the breakout above the resistance level between the two lows signals a bullish move. Stop losses are placed just beyond the second peak for double tops or second trough for double bottoms to manage risk. 3. Triangles. Triangles are continuation patterns, meaning they signal that the ongoing trend is likely to continue. There are three main types. Ascending triangle forms when the price has a horizontal resistance level, but higher lows, indicating strong buying pressure. A breakout above resistance confirms a bullish continuation. Descending triangle, the opposite of an ascending triangle. It has a flat support level with lower highs, signaling strong selling pressure. A breakdown below support confirms a bearish continuation. Symmetrical triangle. This pattern forms when the price consolidates into a tighter range, creating a series of lower highs and higher lows. The breakout can happen in either direction. Trading strategy. Wait for the breakout direction. Enter the trade once the price moves beyond the trend line with strong volume. Place stop losses just inside the pattern to minimize risk. 4. Flags. Flags are strong continuation patterns that occur after a sharp price move. The price then consolidates in a small sloping channel before continuing in the original direction. Bullish flag forms after a strong upward move. The price consolidates in a downward sloping channel before breaking out higher. Bearish flag forms after a sharp decline. The price consolidates in an upward sloping channel before breaking down further. Trading approach. Enter the trade when the price breaks out of the flag in the direction of the original trend. Set stop losses just below for bullish flags or above for bearish flags, the flag formation. The profit target is usually equal to the initial price move before the flag formation. 5. Rectangles. Rectangles represent a period of consolidation where the price moves within parallel support and resistance levels. This pattern can act as either a continuation or reversal signal, depending on the breakout direction. Bullish rectangle. The price moves between two horizontal levels and then breaks out upward. Bearish rectangle. The price moves sideways and then breaks down below support. How to trade it? Buy when the price breaks above resistance in a bullish rectangle. Sell when the price breaks below support in a bearish rectangle. Set stop losses inside the rectangle to protect against false breakouts. Mastering these chart patterns can significantly improve trading accuracy. Whether you're identifying a reversal with head and shoulders, spotting a double top bottom, or riding a flag breakout, understanding these patterns gives traders a structured approach to making decisions. The key is patience. Wait for confirmation, use stop losses wisely, and always trade with a solid risk management plan. Moving averages are a trader's go-to tool for understanding trends. They smooth out price action, making it easier to see where the market is heading. This chapter dives deep into two major types of moving averages: simple moving average, SMA, and exponential moving average, EMA, and explains the best crossover strategies to confirm trends. Simple versus exponential moving averages. Let's start with the basics. Simple moving average is the straightforward average of a set number of past prices. For example, a 10-day SMA adds up the last 10 closing prices and divides by 10. The main benefit? It's easy to calculate and provides a clear view of the overall trend. But there's a catch. It reacts slowly to price changes, which means it might lag behind the market. Now, compare that with the exponential moving average, EMA. The EMA gives more weight to recent prices, so it reacts faster to price changes. This makes it more useful for traders who need quicker signals. If the market suddenly shifts, the EMA will reflect the change much faster than the SMA. So, which one is better? It depends on your trading style. If you prefer a steady, slow-moving trend indicator, the SMA is a solid choice. But if you need something more responsive to market movements, the EMA is the way to go. Best crossover strategies for trend confirmation. Now, let's talk about crossovers, one of the most effective ways to use moving averages for trading signals. A crossover happens when a shorter-term moving average crosses above or below a longer-term one. Here are some of the most powerful crossover strategies. 1. Golden cross. This is a bullish signal. It happens when a short-term moving average, like the 50-day, crosses above a long-term moving average, like the 200-day. Traders see this as confirmation that an uptrend is beginning. 2. Death cross, the opposite of the golden cross. When the short-term moving average crosses below the long-term moving average, it signals a potential downtrend. This is often seen as a warning sign to exit long positions or even consider shorting. 3. 520 EMA crossover, a faster, more aggressive strategy. When the 5-day EMA crosses above the 20-day EMA, it's a short-term buy signal. When it crosses below, it signals a potential sell opportunity. 4. 10 to 50 SMA crossover, a balanced approach. The 10-day SMA crossing above the 50-day suggests bullish momentum. If it crosses below, bearish momentum might be setting in. 5. 200-day moving average strategy. Many traders use the 200-day moving average as a long-term trend filter. If the price stays above it, the market is considered bullish. If it stays below, the market is bearish. Each of these strategies works differently depending on market conditions. Short-term traders often rely on fast EMAs for quick signals, while long-term investors may use SMAs to confirm bigger trends. Momentum indicators are some of the most powerful tools traders use to time their trades. They help identify when a stock, Forex pair, or any other asset is overbought or oversold, making them essential for spotting potential reversals and trend continuations. This chapter focuses on 3 of the best momentum indicators: RSI, MACD, and Stochastic Oscillator, explaining how to use them effectively to enter and exit trades with confidence. Relative Strength Index, RSI. RSI is one of the most widely used momentum indicators, developed by J. Wells Wilder. It measures the strength of recent price movements on a scale from 0 to 100. Typically, an RSI above 70 indicates overbought conditions, suggesting the asset might be due for a pullback, while an RSI below 30 signals oversold conditions, meaning the price could soon rebound. But here's the thing. Traders often make the mistake of blindly buying when RSI is low and selling when it's high. That's not always the best approach. Strong trends can keep RSI in overbought or oversold territory for extended periods. Instead, the key is to look for divergence. When price makes a new high but RSI fails to follow, it's a warning sign that momentum is fading and a reversal could be near. Similarly, if the price makes a new low but RSI doesn't confirm, a bounce might be coming. Another effective strategy is RSI trendline breaks. If RSI is following an uptrend but suddenly breaks its support line, that's often an early warning sign before the actual price drop. The same applies in downtrends. If RSI breaks above a resistance trend line, it could be signaling a shift in momentum. Moving Average Convergence Divergence, ACD. MACD is another powerful tool that helps traders gauge the strength and direction of a trend. It consists of 2 lines: the MACD line, which is the difference between the 12-day and 26-day exponential moving averages, and the signal line, a 9-day moving average of the MACD line. When the MACD line crosses above the signal line, it generates a bullish signal, suggesting momentum is shifting to the upside. When it crosses below, it signals a potential downtrend. But the best trades often come when MACD aligns with price structure. For example, if the price is testing a strong support level and MACD forms a bullish crossover, that adds extra confirmation for a potential reversal. One of the most reliable MACD strategies is histogram divergence. The MACD histogram shows the difference between the MACD and signal lines. If the price is making new highs, but the histogram is shrinking, it signals that bullish momentum is fading. On the flip side, if the price is dropping, but the histogram is making higher lows, it's a clue that bears are losing strength and a bounce could be coming. Stochastic Oscillator. The stochastic oscillator is another excellent momentum tool that compares the closing price to the range over a set period, usually 14 days. Like RSI, it moves between 0 and 100, with readings above 80 indicating overbought conditions and below 20 signaling oversold levels. However, the most effective way to use stochastic isn't just by looking at overbought and oversold levels, it's stochastic crossovers. When the cent K line crosses above the cent D line in oversold territory, it signals potential upward momentum. When it crosses below an overbought territory, it suggests a possible downturn. A powerful technique is using stochastic with trend direction. If a stock is in an uptrend, you don't want to short just because stochastic is overbought. Instead, it's better to wait for stochastic to drop into the oversold area and then turn back up. That's often the best time to buy in an uptrend. The same concept applies to downtrends. Another advanced method is stochastic divergence, similar to RSI and MACD. If the price makes a new low, but stochastic doesn't follow, that's a strong clue that selling pressure is weakening. Combining all three for maximum accuracy. While each of these indicators is powerful on its own, the best trading setups come when they align. For example, if RSI is showing oversold conditions, MACD is crossing bullish, and stochastic is turning up from oversold levels, that creates a high probability trade setup. The key is confluence. When multiple indicators tell the same story, the signal is much stronger. But one common mistake traders make is relying solely on indicators without considering price action. Always look at key support and resistance levels, trend structure, and volume to confirm what the indicators are suggesting. The goal isn't to blindly follow indicators, but to use them as tools to confirm what the market is already showing. Mastering these oscillators takes practice, but once you learn how to read them effectively, they can help you time your entries and exits with much greater confidence. Japanese candlestick patterns are a powerful tool for traders, providing visual insights into market psychology. These patterns help traders anticipate price movements by analyzing how buyers and sellers interact within a given time frame. This chapter explores some of the most essential candlestick formations that every trader should know: doji, engulfing, hammer, hanging man, and more. Understanding candlestick patterns. Each candlestick on a chart represents a battle between buyers and sellers. The shape, size, and positioning of the candles tell a story about who is in control: the bulls, buyers, or the bears, sellers. By recognizing patterns, traders can make better market predictions. Now, let's break down some of the key candlestick patterns. Doji, a sign of indecision. A doji forms when the opening and closing prices are nearly the same, creating a candle with a very small or non-existent body. This pattern suggests market indecision. Neither buyers nor sellers have full control. There are different types of doji. Standard doji, a neutral signal that requires confirmation from the next candle. Dragonfly doji has a long lower wick and no upper wick, indicating potential bullish reversal. Gravestone doji has a long upper wick and no lower wick, signaling potential bearish reversal. Four-price doji, rare and shows complete market stagnation. A doji appearing after a strong uptrend or downtrend often signals a possible reversal. However, traders should wait for confirmation from the next candlestick before acting. Engulfing patterns, reversal signals. Engulfing patterns consist of two candles. The second candle completely engulfs the body of the first one, signaling a shift in momentum. Bullish engulfing occurs after a downtrend. A large bullish candle fully engulfs the previous bearish candle, suggesting a reversal to the upside. Bearish engulfing appears after an uptrend. A strong bearish candle swallows the prior bullish candle, indicating a shift towards selling pressure. These patterns are more reliable when they form at key support or resistance levels. Hammer and hanging man, spotting reversals. Both the hammer and hanging man have small bodies and long lower wicks, but their meaning depends on their placement in a trend. Hammer appears after a downtrend. The long lower wick shows that sellers tried to push the price lower, but buyers regained control and pushed it back up. This signals a potential bullish reversal. Hanging man forms after an uptrend. It looks similar to a hammer, but suggests that selling pressure is increasing. If confirmed by a bearish candle, it signals a potential reversal to the downside. Morning star and evening star, Strong reversal indicators. Morning star, a three-candle pattern that signals a bullish reversal. It starts with a long bearish candle, followed by a small-bodied candle, indicating indecision, and ends with a strong bullish candle. This suggests that buying pressure is taking over. Evening star, the opposite of a morning star. It starts with a strong bullish candle, followed by an indecisive small candle, and finishes with a bearish candle. This signals a possible trend reversal to the downside. Shooting star, a warning for buyers. A shooting star appears at the top of an uptrend. It has a small body and a long upper wick, showing that buyers tried to push the price higher but failed. This suggests that sellers are gaining control and a downtrend may follow. Using candlestick patterns effectively. Always wait for confirmation. A single candlestick pattern should not be used in isolation. Traders should look for confirmation from the next few candles or other technical indicators. Combine with support and resistance levels. Candlestick signals become more powerful when they appear near key price levels. Consider volume. Higher trading volume adds strength to a candlestick pattern, making it more reliable. Understanding these candlestick formations gives traders an edge by revealing shifts in market sentiment before major price moves happen. Recognizing these patterns and using them with other technical tools can help traders make more informed decisions. The secrets of Elliott wave theory. Elliott wave theory is like a secret language of the market. Once you understand it, you start seeing patterns everywhere. This chapter breaks down how price movements aren't random, but follow a structured rhythm of impulse and corrective waves. Traders who grasp this concept gain an edge in predicting market trends with precision. How impulse and corrective waves shape market trends. At the core of Elliott wave theory lies the idea that markets move in cycles, driven by investor psychology. This movement is divided into two main types of waves. 1. Impulse waves. These are the dominant moves in the direction of the trend. 2. Corrective waves. These are the pullbacks that temporarily go against the main trend. Impulse waves can consist of 5 distinct waves. Wave 1, the initial move that starts a new trend. Wave 2, a pullback that shakes out weak hands. Wave 3, the strongest and longest wave, where momentum builds up. Wave 4, a smaller correction before the final push. Wave 5, the last move before the trend reverses. After these 5 waves, the market enters a corrective phase, typically forming an ABC pattern. Wave A, the first counter-trend move. Wave B, a temporary bounce that gives false hope. The final drop before the trend stabilizes or reverses. This cycle repeats across different timeframes, from intraday charts to long-term market cycles. Using Fibonacci ratios to predict price movements. Now here's where things get even more interesting. Fibonacci ratios. These magical numbers derived from nature also influence financial markets. Traders use Fibonacci retracements and extensions to predict where waves will begin and end. Retracement levels, 38.2%, 50%, 61.8%. These are key zones where corrective waves often pause before resuming the trend. Extension levels, 1.618, 2.6118, etc. These help estimate where impulse waves might reach their peak. For example, if wave 1 moves $10, wave 2 might retrace 50% of that, $5, and wave 3 could extend 1.618 times wave 1's length, $16.18 move. This mathematical relationship gives traders a way to anticipate future price action with higher accuracy. Why this matters for traders. Understanding Elliott wave theory isn't just about labeling charts, it's about recognizing market psychology in action. When traders spot a wave 3 forming, they know momentum is strong, and it's time to ride the trend. When a wave 5 ends, they prepare for a possible reversal. And by using Fibonacci tools, they can fine-tune their entries and exits. Dow theory, the foundation of technical analysis. Technical analysis, as we know it today, is built on the foundation of Dow theory. This chapter breaks down its core principles and explains why they are still relevant in modern trading. Let's get into it. Understanding trends, primary, secondary, and minor. One of the biggest contributions of Dow theory is the classification of market trends. According to this framework, price movements don't happen randomly. They follow a structured path. 1. Primary trend. This is the dominant movement of the market, lasting from several months to years. Think of it as the broad direction, either bullish or bearish. A bull market means prices are making higher highs and higher lows over an extended period, while a bear market shows lower highs and lower lows. Investors who recognize the primary trend early can align their trades with the overall market direction. 2. Secondary trend. These are corrections within the primary trend. They usually last from weeks to a few months and move in the opposite direction of the primary trend. In a bull market, a secondary trend would be a temporary pullback, while in a bear market, it would be a short-lived rally. These movements shake out weak hands and test market conviction. 3. Minor trend. These are short-term price movements lasting days or weeks. While they might seem significant on a daily chart, they are just noise compared to the larger trends. Traders focusing too much on these fluctuations often get trapped in emotional decisions, losing sight of the bigger picture. How Dow theory still applies to modern trading. Even though Dow theory was developed over a century ago, its principles still shape how traders analyze the market today. Here's why. Trend confirmation still matters. Dow emphasized that a trend remains in place until there's a clear signal of reversal. This idea still holds true, as traders today use tools like moving averages and trend lines to confirm trends before making decisions. Market phases are timeless. According to Dow, markets go through accumulation, public participation, and distribution phases. These patterns still play out exactly the same way today, whether in stocks, crypto, or Forex. Smart money enters early, the public jumps in when trends gain momentum, and eventually, experienced traders exit before the trend reverses. Volume as a confirmation tool. Dow believed that volume should confirm price action. If prices are rising on high volume, the trend is strong. If volume is low, the move might not be sustainable. Modern traders still rely on this principle, using indicators like the volume-weighted average price, VWAP, to assess market strength. Emotional cycles haven't changed. Market psychology is the same today as it was in Dow's time. Greed, fear, hope, and panic drive price movements, leading to the same repeating patterns. Understanding these emotions helps traders avoid making impulsive decisions. So there you have it. We just explored some of the most powerful concepts from technical analysis of the financial markets by John Murphy. Whether it's identifying trends, mastering chart patterns, or using indicators like RSI and MACD, these tools can give you an edge in trading. Now, it's your turn. Start applying these strategies, analyze the markets, and refine your trading skills. And if you found this video helpful, don't forget to like, share, and subscribe to stay updated with more valuable content. Thanks for watching, and see you in the next one.